A blockchain can be thought of as a ledger, a digital ledger. A ledger is where records are kept. You're going to your bank 100 years ago. There's someone who looks a bit like me, sitting behind a high desk or with a quill in my hand, marking money as it's coming in and marking money as it's going out. And I've got a ledger in front of me and it's being done by hand. And that's how all these things used to be done in the old days. In an electronic world, when you put it onto the computer system, this will be called a blockchain. The system is built to police itself. There's a computer coding that's working in the background, making sure that things are only being marked onto the ledger when they have been agreed by all the participants, and they are the Bitcoin miners. The first person to agree that block, and everybody else then agrees it, wins a little prize of some Bitcoin. So the Bitcoin miners make sure the system works. The system is completely protected in terms of coding, so nobody can muck around with it. And that is your first example of a blockchain. And there is a limit to the amount of Bitcoin that ever can be created, because it's going to get more and more expensive. Over time, it gets more and more expensive through a process called halving. There can only ever be 21 million of them, and there are 19.7 million at the moment. As with all cryptocurrencies, Bitcoin included, they're very easy to trade on these exchanges, but it's very difficult to get money from your bank to a platform because, given the reputation that cryptocurrencies have got, it's a very highly regulated process. And so when we think about how are we going to reflect positions in this world, if we want to have any within our portfolio, we're going to be thinking in terms of an ETF, or buying off a platform such as IG.